How's it going today, guys? Welcome back to the channel. I hope you're having a great day so far. So in this video today, we're going to be covering one of my favorite topics to talk about on this channel, and that is index funds for beginners. Not to mention, I'm going to be showing you step by step how anyone out there can become a passive millionaire utilizing index funds and recurring investments. Now, real quick, guys, I do have to make a disclaimer here that I am not a financial advisor, and this video here is not any sort of financial advice, and you should always do your own research and due diligence above and beyond this video before investing in anything out there. Also, guys, I have been getting a lot of spam and scam comments down below, so I just wanted to remind you to make sure you're being safe down there, and if you are communicating with me, make sure there is that white check next to my name. Otherwise, you might be talking to somebody who's impersonating me and trying to steal your money or something like that. So starting off here, guys, let's talk about what is a market index. So a market index is a hypothetical holding of investments that represents a segment of the financial markets. Indexes are used as a benchmark to gauge performances of market segments. So for example, there's indexes out there that track technology, and this would be showing you the aggregate performance of stocks like Google, Facebook, or Amazon. And then for another example, there's indexes out there that track the automotive industry that would give you, the aggregate performance of stocks like Honda, General Motors, Tesla, and Ford. Investors use indexes as a basis for active or passive investing. So basically what you need to know here is it's a basket of different stocks. Sometimes they're related to each other, sometimes they're not related to each other, and it's a way for you to track the performance of this entire basket and then potentially make an investment in that entire basket of companies. So now that we understand what a market index is, what exactly is an index fund? Well, this is going to be a portfolio of stocks and bonds potentially built to mimic a financial market index as closely as possible. Lower fees are associated with index funds than actively managed funds. This is because rather than trying to beat the market, these funds simply aim to own the market. So that can be done in a much more passive and less time-consuming manner, making this a passive investment strategy. So with an index fund, the goal is to seek to match the risk and return of the overall market. And here we have a quote from Warren Buffett that says, "By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals." So this is pretty much something that is pretty widely known now, and that is the fact that most professional stock pickers actually don't even beat the market. So if you're paying someone to actively manage your money, you're probably just pissing money away at that point in time, because most of these professional stock pickers don't beat the market, and then even the ones that do typically don't do it every single year. So that is why a lot of people have gone away from, mutual funds and instead are following this Warren and Buffett-esque advice here, which is to simply buy and hold index funds. So now let's cover some index fund examples, starting with the S&P 500. This is a market cap weighted index holding the top 500 largest companies in the United States that are, of course, publicly traded. Next up, another popular one is called the Dow or the Dow Jones. Well, the Dow Jones Industrial Average is a price-weighted index holding the top 30 largest companies in their corresponding industry. So when you're looking at the Dow Jones compared to the S&P 500, you're now looking at a basket of 30 stocks in the Dow compared to a basket of 500 in the S&P 500. Another example of an index here is the Barclays Aggregate Bond Index. This is a market cap weighted index of investment grade bonds that trade in the United States. And then lastly, another one that most of us are familiar with is the NASDAQ. The NASDAQ Composite is a large market cap weighted index made up of 3,000 stocks listed on the NASDAQ exchange. Now, before we go any further here, I think it's important to understand the differences in the goals behind passive versus active money management. So what we're talking about here with index fund investing falls on the category here of passive instead of active, but it's just good to understand the difference and how these basically work. So from a passive fund management approach, the goal here is to earn market returns. And this is something that an individual is most likely going to do themselves. Or you could also find, a financial advisor who can help set you up with a portfolio of different index funds. You're going to find that the cost here is going to be much lower than active portfolio management, and that's simply because, you're not paying anybody to make these decisions. You're basically replicating market indexes, which can be accomplished in a much less expensive manner. However, with this passive approach, you don't have much control over your investments, and you don't really have any real, individual ownership unless you decide to add some individual shares of stocks to your portfolio. So for better or worse, as a passive index fund investor, you're pretty much along for the ride with whatever the broad market is doing at that point in time. Now, on the other hand, with active fund management, the goal is, of course, to beat the market returns. And this is something that both individuals as well as professionals try to accomplish. So individual retail investors will oftentimes decide to pick individual stocks themselves with the goal of beating the S&P 500, which is considered to be the average market return. Or this could be a situation where you're paying a professional, hedge fund manager or mutual fund manager who is supposedly, picking and choosing stocks and funds with that same goal of beating the return of the S&P 500. With the active approach, if you're using a professional, the cost is going to be higher. If you're picking and choosing stocks yourself, it's probably not going to be any difference. As long as you're using a commission-free brokerage. And with an active strategy, you have a much higher level of control over your investments and the outcome. So some examples of this include, as we mentioned, individual stock picking or some mutual funds out there that are actively managed. So what are some of the benefits of index funds? Well, first of all, it's lower risk than buying individual stocks because you have greater diversification. Instead of just owning a handful of different individual stocks, if you, for example, invested in an S&P 500 tracking index fund, you would own a small piece of 500 different companies. Now, that being said, these indexes are often market cap weighted, so that means that you're going to have more of that money invested based on the size of these companies. So in the case of the S&P 500, that means that about 30% of that total money invested from that fund goes into about the top 10 holdings, but it does still give you exposure to a lot of different companies instead of just a small handful. The next benefit here is often you have lower taxes associated with this type of investment, and that is because an active fund is going to be placing, buy and sell orders on a frequent basis, and this can oftentimes result in short-term capital gains. With an index fund, if you're buying and holding for the long term, you can recognize almost exclusively long-term capital gains, which means you're going to be paying a lot less in taxes, as long as you're holding these things for longer than 1 calendar year. And then lastly, the lower costs associated with managing index funds mean that you're paying less money in fees and allowing more money to remain invested and potentially compounding every single year. So when it comes down to actually researching or analyzing index funds, here's a few important criteria that you should be looking at, starting off with the all-important expense ratio. This is basically the fee for investing in an index fund, and it's typically less than 1%, hopefully way less than 1%. So just for example's sake here, let's say you invested $100 into an index fund and the expense ratio is 0.5%. You would take 100 times that percentage, and that means that the expense ratio that you would pay is 50 cents every single year on that $100 investment. The next thing we want to cover here is called the tracking error, and this is how closely the fund follows the underlying asset. The next thing to look at is NAV, or net asset value. This is total assets minus the liabilities of the fund. And then the next thing to look at is the holdings, or the market segment, which is basically going to answer the question, what stocks or bonds are in the fund, as well as why. So for example, if it's an index fund tracking semiconductors, you'd want to understand why these particular companies, like for example, maybe Advanced Micro Devices, are included in that portfolio. So now let's dive into an example here of a Vanguard index fund looking at these specific criteria. And this right here, as we said, is pretty much the most popular one. It is the Vanguard 500 Index Fund ETF, trading under the symbol VOO. So the first thing I want to direct your attention towards is the bottom right, and this shows you exactly what I was talking about earlier. That is the market cap weighted distribution of this fund, and you can see where roughly 30% of this entire fund is in those 10 stocks right there, and the other 70% of the fund is spread across about 490 other smaller companies. So because the giant companies in our lives have gotten so big, unfortunately, investment in, well, it could be fortunate or unfortunate, but nonetheless, the reality here is that a lot of your money invested in the S&P 500 is concentrated into Apple, Microsoft, Amazon, Facebook, Google, Tesla, Nvidia, Berkshire Hathaway, and JP Morgan. But obviously, if those companies continue to do well, that could be a wise investment. Looking at the other criteria here, with the Vanguard Index Fund example here for VOO, the expense ratio comes in at 0.03%, which is extremely low. The tracking error is just 0.01, which means it follows the underlying index, the S&P 500, very closely. Net assets comes in at $268 billion, and then the holdings amount for 511 individual different stocks, and the top 10 holdings alone make up 28% of the fund. Now, of course, Vanguard has some phenomenal index funds out there, and most people like using Vanguard as their fund provider, but there's a lot of really solid options out there, so I wanted to give you guys some different options here for providers of index funds. So obviously, the most popular is Vanguard, founded in 1975, and popular index funds include VFIAX, VTSAX, and VBTLX, and they have $7.1 trillion in assets under management. After that, actually, this is pretty surprising. I didn't know Schwab had more assets under management than Vanguard, but they actually do. Schwab was founded in 1971, $7.6 trillion in assets under management, and popular index funds include SFLNX, SFNNX, and SWPPX. Next up, we have BlackRock, founded in 1988. They have an astounding $9.5 trillion in assets under management, and popular index funds include BSPAX, BRGAX, and BASMX. Lastly, another name we should all be familiar with, that is Fidelity. They were founded in 1946. They have $4.2 trillion in assets under management, and popular index funds include FXAIX, FSKAX, and FSPGX. So all of these different, providers are going to have a section on their website where you can look through the different index fund offerings. So this is a great place to begin your search, is looking with one of these four providers. So now let's cover how as well as where to actually buy index funds, and it sort of looks like this strategy right here. You start off all the way on the left, which is basically determining your overall investment strategy. So are you looking to invest in a particular segment of the market, for example, automotive or semiconductors, or are you looking to just simply own a broad market index like VOO, tracking the S&P 500. You also want to ask yourself the question here of, are you more focused on growth, where you're looking for increase in the share price, or are you focused on earning cash flow from high yielding dividend stocks? Because you can find a lot of different index funds with a growth oriented or a income oriented approach. So once you understand what your investment strategy is, after that, you want to figure out a regular investing schedule. That way you can take advantage of something called dollar cost averaging. So with index funds, you don't want to just dump a bunch of money in all at once. The general strategy that most recommend is regular contributions, whether it's weekly or monthly, over a long period of time. So basically, you're going to figure this out based on looking at, a percentage of your income or however you want to do it. And you should also be thinking about whether you want to be investing in a taxable brokerage account or a retirement account. And that's going to be something that you determine based on the goal of what your plan is to actually do with this money. So once you figure that out, the next step is to choose a brokerage, and there's a lot of different ones to choose from, but the one that I personally use myself is M1 Finance. I like them because they offer fractional shares, there's no trading commissions, and they even offer a number of expert pies or portfolios that actually have, index funds right in there. So if you don't want to have to build an index fund portfolio yourself, you can invest in one of these expert curated portfolios, and there's no management fee of any kind associated with that investment. And then after that, the last question you have to ask yourself is around compound interest, and that is whether or not you want to reinvest your dividends. Obviously, if you're looking to maximize your returns, reinvesting the dividends earned from your portfolio is going to allow you to buy more shares over time. More of those shares are going to result in more dividends, and that's just going to grow and grow your wealth over time. However, some people actually, take their quarterly dividends and they may use that for their life expenses, and that just depends on where you're at in your life and if you're looking to grow your money or start using your money. With M1 Finance, there is a portfolio level dividend reinvestment. So basically, anytime if you turn on auto invest, anytime your portfolio hits $25 cash or more, they're going to automatically reinvest that money across your entire portfolio and attempt to rebalance it in the process. So a bit more information here, guys, on the M1 Finance Expert Pies. This is a selection of over 80 pre-built portfolios curated by experts. However, they also have custom pies or portfolios where you're able to basically build your own investment portfolio, choosing from over 600 different stocks as well as funds. Or if you want, you can follow a blended approach where you invest a portion of your money into an expert-built portfolio, and then maybe you manage the other portion yourself and compare the returns over time to see if you're able to successfully beat the market with your active involvement. They also have smart rebalancing, which basically rebalances as you go here by when you add or remove money from the portfolio. It's going to return you as closely as possible to your original target allocations. So if you guys want to check this out, M1 Finance, there's going to be an affiliate link down in the description below, basically at no additional cost to you. If you want to give back to me for putting this video together, that is greatly appreciated but never expected. I also have a completely free 30-minute video training that walks you through step-by-step how to get started with M1 Finance and build up an investment portfolio. So if you're interested in that, I will also include a link down in the description below. Now, as far as the M1 Finance Expert pies, they're broken down into 7 different categories. Number 1, general investing. Number 2, plans for retirement. Number 3, responsible investing. Number 4, income earners. Number 5, hedge fund followers. Number 6, just stocks and bonds. And number 7, other strategies. So what you're going to find in here for the retirement plans is they offer target date retirement funds, which is pretty nifty. You basically put your goal date of when you want to retire, and then as you get closer to that age, they're going to automatically reallocate or change the allocations of that fund to make sure you're not taking on too much risk. So if you're a retirement investor, you could literally, put your money into a TDF for like 2050, put it on autopilot and completely forget about it. And you wouldn't have to worry about taking on too much or too little risk because it's going to be reallocated automatically without your involvement. So let's do a quick overview here looking at one of these M1 Finance Expert pies just so we can see what index funds actually go inside of it. So we're looking at general investing and then the moderately aggressive pie. And what we can see here is that it holds 8 different slices, all of which are Vanguard index funds. And the expense ratio in total across all of this comes in at just 0.05%. So you will pay that expense ratio to Vanguard, but you don't pay any fees or management fees whatsoever to M1 Finance. And across all of these funds, the aggregate dividend yield is currently 1.83%. So over on the right, that shows you what the individual holdings are of this portfolio, and you can click into every single one of these expert pies and see exactly what index funds they are using to give you this type of diversification. Now, the last thing I want to cover is how to actually become a millionaire with these index fund investments, and it comes down to a quote here from Albert Einstein. It says, "Compound interest is the 8th wonder of the world. He who understands it earns it, he who doesn't pays it." And this is basically referring to the difference between compound interest and compound debt. A lot of people, without realizing it, have compounding debt in their lives in the form of, credit cards that are continuing to rack up interest. That's basically someone else's compound interest. That's compound interest, but for the bank to earn. What you're looking to do is set up your own compound interest investments where instead of paying compounding debt, you're building up, compounding returns over time. So let's take a look at a very simple path to a $1 million retirement. This would be an initial deposit of $2,000 and then a monthly contribution of just $200 or $50 every single week. Assuming you have an average return from the market of 9% and you do this for 40 years, you would literally end up with a $1 million account just from investing $200 every single month and an initial investment of $2,000. It doesn't take a crazy amount of money to build up a $1 million portfolio. It just takes a lot of patience and a decent amount of time to allow that money to grow. So anyways, guys, that's going to wrap up this video. I hope you enjoyed it. This was basically a crash course on index funds. If you have any questions, go ahead and drop them down in the comment section below. Like I said, if you want to check out and learn more about M1 Finance, there's going to be a link down in the description below. I'll also toss up a QR code on the screen if you want to download the app. All you have to do is basically hold up your phone in the camera and it's going to bring that link right to your phone to open up an account. There's also a link for that completely free 30-minute M1 Finance step-by-step training down below. But thank you so much for tuning in, guys. Drop a like and subscribe if you haven't already. And as always, I hope to see you in the next video.